There's a little bit of a China angle to there, Michelle. A lot of countries, Turkey's a great example, have been looking to China and saying, whatever our options were in the past, we've got a big, new, important one, and that's China. It's going to be a big source of demand for us, going to be a big investor. China's got its own economic fundamental concerns. That means Turkey needs to get back to its fundamentals. The fundamentals are the way forward for Turkey, not counting on some big new player in the global economy to ride in and offer a way out.
Let's talk about that big global, what was supposedly going to be the new big global player. What do you make of these reports that there's criticism of Xi Jinping and his response to President Trump and the handling of the crisis there?
Low intellectual nutrient value. Pretty easy on your way to the beach to write a story that says that there are some debates and differences of opinion in Beijing. But look, Xi Jinping was chosen for his role because the whole leadership thought it was time for China to step up in the world. This is not just him dragging the country kicking and screaming into trying to be more of a superpower. So that's not really surprising. We're wasting too much time talking about those politics because it's kind of fun and it's good beach reading. There are fundamental economic issues in China today that are first-order concerns, especially for the markets, and those deserve a lot more attention.
Exactly.
Such as, let's look across the spectrum on the trade side, right? We had data this week that people thought looked pretty good because Chinese exports were export growth holding up around 12%. 12% is the monthly average for the past year, and it came in July, a month where you'd had the most depreciation that we had seen inside 1 month since the 1994 start of the modern era for the Chinese exchange rate. And all they could do was keep pace with the 12-month average growth rate of exports. So something's not going right on the trade side. Meanwhile, back home, the really large issues for China are domestic debt. It's not the trade wars, it's their domestic situation. And we've got default rates showing up because they can't follow the US Fed up. They got to keep rates lower because they're on the cusp of defaults across the board. We saw buses lining up to take protesters home from Beijing over last weekend, right? More of that to come.
The story has always been, though, that there's sort of a higher pain threshold for dealing with potential economic hardship from the trade side, as well as, the Chinese authorities' ability to kind of keep refreshing the system with more liquidity and just keep the balls in the air. Has that changed?
Well, the party has a high pain threshold because party members don't really feel a lot of that pain, but average Chinese do. And you have Chinese looking at the value of their currency holdings falling against their cousins who already have an apartment in California, looking at how much better they would have done if they'd been able to move just a little bit of their life savings out a couple months ago rather than now. And are we done yet with exchange rate movements? My colleagues and I at Rhodium don't think so. I think most of the market out there is starting to agree with that.
The U.S. market versus the Chinese market. Some say, see, that shows the U.S. is winning. What is it? Is it?
Would be a very dangerous inference to draw. U.S. is in year one of the biggest stimulative boom that we've dropped on the economy from on high, and you can only do that once every couple decades, really. You don't get away with that for long before the inflationary consequences come home to roost. We have that to look forward to probably next year. You guys are thinking about that even more than me. So that's the U.S. story. On the Chinese side, yeah, as I say, there's a lot of fundamental domestic limits to debt financing for them, and that's showing up in their markets.